When comparing stocks and bonds, the essential trade-off is risk versus return. Stocks represent ownership in a company. When the company grows or profits, your share can rise in value, and you may receive dividends. But stocks are volatile. Prices can swing wildly due to earnings, sentiment, macro events, or even rumors. There's no guaranteed return. Over the long run, equities tend to outperform bonds, but only if you can tolerate the ups and downs. Bonds, on the other hand, are debt instruments. You lend money to a government or company. In return, you receive fixed interest payments, the coupon, and get your principal back at maturity if all goes well. Bond returns are more stable and predictable, with less volatility, but that lower risk generally means lower potential return. Because stocks are riskier, investors demand a risk premium, extra return for bearing that risk. That's why historically stocks have averaged higher returns than bonds over long periods. Still, bonds have their strengths. In a market crash, bonds often fall less or even rise if interest rates drop. In bankruptcy, bondholders have priority over shareholders and claims. Thus, many portfolios mix both: stocks for growth, bonds for stability. The right mix depends on your goals, risk tolerance, and timeline.